Now, I like a good crime drama, uh, where some detective looks to solve some kind of mystery, and and, when they're dealing with crime, you often hear the detectives or the lawyers, talk about, what was the motive? Was there a motive? Was there was there opportunity? Um, and was it premeditated? All these factors go into, maybe proving whether or not somebody did the thing. Yeah. Now, when we look at uh, perhaps crimes of a business nature, fraud in particular, we often frame it in that kind of way. In regards to why do people commit fraud? Uh, you know, is there motivation? What is the motivation? Is there some kind of force or pressure um, pulling the individual towards fraudulent activity? Maybe it's external pressure, from a superior, for example, in a workplace, or maybe it's internal pressure. Maybe you've got gambling debts that are piling up, for example, and also, what about, is there opportunity? All of us might like to get money, empty out, money from the safe of a bank, for example, but maybe not all of us, but do any of us have the opportunity? Do any of us have the skill sets to rob a bank, let's say? Uh, that's why a lot of fraud happens internally within a business, because there is opportunity. Yeah, opportunity for those that are embedded into systems to be able to manipulate those systems. And then there's the final part of it, the premeditation, or perhaps what we might call rationalization. That is, most of us, even if we had the opportunity and even if we did have self-interest, would still not do the fraud. Yet we still need to have something that pushes us over the edge, and this might be some kind of rationalization. This might be, well, those clients won't miss the money. Yeah. Or my company's so big, they won't notice. Or my company underpays me, so maybe I'm owed this money anyway, or this thing, so we rationalize. And usually all three of those things need to hit for an individual to commit fraud. One other aspect, though, that we need to consider in all of this is the impact. Now, when in our rationalization, we would think about impact, like I kind of mentioned, maybe there's no impact on anybody, therefore it's okay. But part of the motivation when it comes to impact is, how much can I get out of this? If potentially I'm going to ruin my life through this action, what is the upside? And this is, I think, where the discussion of financial fraud and unethical behavior in finance in particular has a niche. If I was working, I don't know, in a, let's say in a factory, yeah, and I wanted to commit fraud, what is the scale of my fraud likely to look like? Maybe it's siphoning off some of the product into my van, yeah. Maybe it's taking some raw materials, but it's likely to be something to do with some material thing. In a bit, I like a good wind, nice and breezy. But yeah, it's likely to be some kind of physical thing that we are stealing, let's say. There's limits to that, right? There's limits before someone would notice in particular, but limits to just the logistics of it. Like if you wanted to steal everything in the factory, well, you're probably going to need a whole bunch of trucks, you're going to need a whole bunch of truck drivers. How do you move it? How do you then get rid of it? How do you monetize it? All that kind of thing. It's difficult to, in particular, difficult to upscale the fraud. You could take something small, no one would notice. But if you want to take something big, very difficult and easily noticeable. But in the world of finance, the ability for big impact, the ability to leverage up the crime is infinitely more achievable. That is, if you can steal $1, you can probably steal $1 million. Yeah. If you can do one little bit of fraud somewhere, if you have the skill sets to siphon off a little bit of money from one person's account, you probably could do that for thousands of people's accounts. Yeah. It doesn't take that much more effort to leverage up the fraud. And so ethics in finance has this other and very critical side to it. And that's why we talk about ethics in finance. That's why it's important for regulators to understand this issue and to help regulate it against it. Now, when we talk about impact in relation to ethical misconduct in finance, we also need to understand perhaps the systemic nature of the world of finance. That is, impacts can be far-reaching. In the early 2000s in the US, banks started to realize that they could package together loans, and especially low-quality loans, and investors weren't really paying attention to the quality of loan books that were being sold or packaged up into mortgage-backed securities in particular. That is, and it wasn't just investors. We might say credit rating houses as well, whose task it is to provide insight to investors on the credit worthiness of such assets, was somewhat missing. So now there's an opportunity. That is, those guardrails that are in place, perhaps credit rating houses or the investment analysis which should have been taking place, wasn't there. And so banks started to realize we could write more of these mortgages and we could sell them off. We could write mortgages or underwrite mortgages that were poor quality. That is, there was a high chance that there would be default. And we could package them together with a whole bunch of other similar mortgages, and investors would be willing to pay us a high price for these loans, higher than what they should be valued at. And so this then led to kind of the next level of this unethical behavior, the opportunity there. So let's underwrite more mortgages. Now there's an opportunity for mortgage brokers also to make money here. That is, banks are telling them just to go write as much mortgages. Don't worry about credit worthiness. Just get people to buy houses, even if it's obvious that they couldn't afford the house. It's okay because we can package this up, and the risk isn't on us. Well, you leave that kind of system going long enough, you build up a huge chunk of assets out there that and loans out there that are rubbish, that will never be paid off. Another side of this was also to help those that couldn't afford the loans take out the loans, because you have to repay the mortgage, right, straight away. Well, not if you offer honeymoon rates, not if you offer very, very cheap temporary rates, 2-year, 3-year honeymoon rates. Well, I can afford those. Now, rationalization here, it's obvious that this is wrong, but rationalization might be, well, at least we're getting people who couldn't get into homes and couldn't afford these homes, we're getting them into these homes. Maybe over the 2-3 years, they will get better employment, they'll get higher paying jobs, and then they can afford this loan then. Yep. Now that didn't happen, and default started to roll in, and sooner or later this house of cards came tumbling down. Now the reason why I mention this is just in regards to impact. That is, this was fraudulent activity conducted by banks, investment banks, mortgage brokers over a few years, but in a fairly niche area. It's subprime mortgages, people who just those people that couldn't afford, and yes, hopefully after a while they could start to afford, especially once the honeymoon rates ended, and perhaps they could afford the higher rates. But this system of fraud brought down the entire global economy. It wasn't just limited to, okay, that person now is bankrupt, or that person can't afford the mortgage anymore, so they lose their house. Oh, that's a shame. Yeah. Negative impact on them. Yeah. It wasn't just that some investors who bought these mortgage-backed securities started losing money. People who thought that this was, A-rated, no chance of going bust. Oh, now some pension funds start losing money. That's a shame. It wasn't just limited to isolated incidents of impact. It brought down the whole global financial system. We call it a credit crunch. This is, especially when we talk about the systemic nature of the finance world. Banks are all linked together. They all have obligations with each other, and they're all looking for the cheapest way to fund their operations and fund their assets, their loans. And this interconnectedness means that if one bank falls over, many banks fall over. If many banks fall over, no banks want to deal with any other bank, because you don't know who's going to fall over next. Yeah. So ethics in finance is not just an important concept because the opportunity there is for big fraud. It's also important because it has far-reaching impacts. millions of people lost their jobs throughout this, as the finance world tried to grapple with unwinding this issue. Europe went into, and a lot of Europe went into what you might call a depression. US suffered the Great Recession, yeah? And then the other things that followed from that. Euro debt crisis, for example. Big impacts, far-reaching impacts that lasted a long, long time.
Now, eagle-eyed viewers may have spotted some familiar landmarks in this video, so to play the Where is Dr. Dan game, head over to my Substack to be the first to log your location guess. See you next time.